ありがとうございました。それではこれより基調対談に移らせ。
Thank you very much. We will proceed to the keynote dialogue or the fireside chat. The panelists will come up on the stage. Please welcome them with a big round of applause.
よろしくお願いいたします。
Thank you. Now the proceeding will be done by Ms. Tracey Wingate. She will be the moderator of this session. So, Ms. Wingate, please take the floor.
'Testing. Perfect. Thank you all for joining us today for this panel. I have sitting next to me two very illustrious panelists that I will introduce but do not need any introduction. Let me tell you just briefly a little bit about our panel, Collaboration Among International Financial Centers in an Era of Global Upheaval. So our theme today is to talk about how Tokyo and Frankfurt, as key international financial centers, will make a huge difference in 2026 and beyond. They are very well primed to actually become critical international financial centers. So I will ask my panelists some questions, driving at their thoughts about how we're going to make this so. So let me first start off with someone, again, who needs no introduction. NAKASO-san is obviously the chair of FinCity.Tokyo and has been since it was first established in 2019. He has had quite a distinguished career in both the public and private sector, including over 3 decades at the Bank of Japan, where in fact he was deputy governor. He is also currently the chair of Daiwa Institute of Research, and he serves as Japan's representative to the APAC Business Advisory Council. He also chairs the Policy Evaluation Committee at FSA and the Monitoring Committee for Japan's over 10 trillion yen University Endowment Fund. So thank you for being with us today, Nakasan-san. Next, we have, yes, round of applause. And next we have Oliver Behrens, who has also had quite a distinguished career, over 40 years in the private sector. As you all may be aware, he is the current president of Frankfurt Main Finance and has been since October of 2024. He is also the CEO of FlatX Desjardins, which is a European online financial brokerage firm, as well as the bank. He is also the chair of the supervisory board of DS Group. He previously led at Morgan Stanley their operations in Germany and served on the board of directors at Morgan Stanley International Limited. And he began his career at Deutsche Bank, as well as DECA Bank, where he held several senior positions, including chair of the board. Thank you so much for being with us today, Mr. Behrens. So let's start here. Last night, a historical memorandum of understanding was signed between FinCity and Frankfurt Main Finance. This MOU will connect 2 financial centers to strengthen coordination between Europe and Asia and find joint opportunities to promote capital market development between these 2 key cities, Frankfurt and Tokyo. While both centers will continue to play a role in shaping the future of international finance, finding ways for greater growth and collaboration will propel both of them to deeper capital market development. So, let's dig into the discussion. My first question I will ask to NAKASO-san. Looking back at 2025, what are the trends, the mega trends that you think have posed challenges, but also opportunities? This is relevant from where you sit, both with respect to your current role here at FinCity, but also the decades of experience that you've had on the regulatory side. And then second to that is, how do you feel about 2026? Are you pessimistic or optimistic about 2026?
Thank you, Tracey. Let me try to answer. Since the beginning of 2025, almost every morning, we were awoken by the news, surprising news, that took place overnight in the US or elsewhere. And this January, in Davos, Mark Carney, the Canadian Prime Minister, talked about rupture in the world order, the end of the night story. Now, I think his message proved a wake-up call for many of us who were getting more and more used to this kind of routine of life, and the sober reality, which we became more inclined to turn a blind eye to. You mentioned megatrends. I think there are several. These include the rise of America First, widening inequality, heightened geopolitical risks, AI, accelerating climate change, and the expansion of fiscal deficits in many countries. I think these megatrends interact one another. The interplay generates changes to the global and financial order that we were accustomed to or took almost granted. One change, as I see, is the role of the US dollar as the key currency. After World War II, the dollar became the key currency, replacing the sterling that had performed as the key currency under gold standard. Now, even after the breakdown of the Bretton Woods, when the dollar gold standard was abandoned, dollar continued to perform as the most important reserve currency. I think the US dollar supremacy as a key currency was a kind of exorbitant privilege. But I think that it also accompanied costs. The US had to conduct its macroeconomic policy, taking into consideration its implication for the rest of the world. And likewise, the Fed had to perform the lender of last resort in dollar in times of market stress. But I think these fundamental factors that underpin the US dollar supremacy is starting to erode. First, the US stepped down from its former role as the guardian of global order and ceased to be the standard bearer of free trade. And as a result, its economic policies, typically the tariff policy, very erratic, have become highly, highly unpredictable. And secondly, the widening US fiscal deficits, I think, cast some doubt about the sustainability of the soundness of the US Treasury market. And third, President intervention, the persistent intervention by President in the Fed is feared to undermine the independence of the central bank and ultimately jeopardize macroeconomic stability. So for these reasons, I think cracks appearing in the almighty dollar. As a matter of fact, in early April last year, immediately after the Liberation Day, we witnessed a brief period where the value of the dollar assets across the board plunged, as if Minsky moment had arrived. We saw a simultaneous plunge in the US securities, equities, and the dollar exchange rate. Now, interesting thing is that during this corresponding period, Japan saw a record high level of capital inflow. amounting 8.2 trillion yen into equities and bonds combined. So what does this imply? I think, although I don't think the US dollar supremacy is going to be overtaken anytime soon, given the likelihood that the US economy remains the largest economy, at least for a while, and because of the network externality, which means everyone uses the dollar, I think it will remain the key currency. But I expect global investors, for the reasons I mentioned, will start to diversify at least a part of their portfolio away from US dollar into other currencies, including the yen, and other value storage instruments like gold. Therefore, under this situation, other key reserve currencies, including the yen, the euro, the sterling, may have to collectively, I think, function to fill the gap thus far performed by the US dollar to underpin global economic and financial activities. So what this suggests is that financial centers like Tokyo and Frankfurt, built on the foundations of democracy and rule of law, are well positioned, I think, to grasp new responsibilities and bear new opportunities in the shifting global financial landscape. So there are responsibilities and opportunities. That is why I think, I'm cautiously optimistic about the year 2026 and maybe beyond.
Thank you for that, NAKASO-san, for your thoughtful perspective. You have indeed highlighted some cracks in the armor in the existing order, but have also spoken about the opportunities for growth for what I would call a more plural financial landscape in which other major currencies and financial centers will play a greater role. I will now turn to Mr. Behrens to hear his thoughts and reflections on this question, and I'm particularly interested in your view about how pessimistic or optimistic you are for 2026.
Thank you very much, Tracey. First of all, it's a great honor to share the stage with NAKASO-san today. I would also like to express my sincere appreciation to Governor Koike for her thoughtful video message and her continued support of Tokyo as a financial center. And finally, my warm thanks to all of you joining today. Only recently, Prime Minister Sane Takaishi announced a snap election. We saw Japan financial markets had some short-term volatility, but overall remain calm and well functioning. The government and the Bank of Japan communicated clearly and acted in a coordinated way, which helped in reassuring investors. I also want to congratulate on how Prime Minister Takaishi handled this. Now, coming back to your question, Tracey, I would look back at 2025 and would describe the global economy as going through a real reshuffle, almost like a big game of shogi, Japanese chess. Suddenly, the rules on the board changed. As already said, as Canadian Prime Minister Mark Carney stated in Davos, we visited a definitive rupture in the world order, making the end of a pleasant fiction, that economic integration would automatically guarantee security. After the US rolled out sweeping tariffs, many countries realized overnight the old playbook no longer works. As German Chancellor Friedrich Merz warned, we have entered an era of great power politics, where economic dependencies can be weaponized. Security, resilience, and strategic autonomy are not just as important. At the same time, AI became a central pillar of this new competition, driving productivity and industrial policy. Looking ahead, I'm cautiously optimistic. Major economies begin to and have to face the world as it is. Growth may remain modest, but countries are learning how to operate under these new, harsher rules. Against this backdrop, three big megatrends define today, and they matter especially for Germany and Japan. Germany and Japan have a lot in common: export-driven, highly industrialized, democratic, and facing rapid aging population. We will lost most of a world of fortress, but have the greatest capacity to champion a new, resilient framework. Megatrend number one: fragmentation and protectionism from free trade to safe trade. Our both economies heavily rely on China for markets and critical raw materials, while at the same time depending on the US for security. That creates a costly dilemma, choosing between efficiency and security. Germany, for example, we face US tariffs on one side and intense competition from Chinese electric vehicles on the other. And when dependencies become political weapons, think rare earth or battery components, even the most advanced manufacturers are becoming vulnerable. But this also lies in an opportunity. The cracks in the global system are pushing Germany and Japan closer together. Our transformation partnership on supply chain and economic security are good examples. Both countries are redrawing supply chains towards Southeast Asia, Eastern Europe, or parts of the global South. Megatrend number two: AI, productivity, and the new age of electricity. AI crossed this threshold. It stopped being a pilot project and became part of everyday workflows. This triggered a new age of electricity. Data centers, EVs, and digital infrastructure are now driving power demand much faster than overall energy demand. But energy is expensive. Germany is still struggling with high electricity prices after losing cheap Russian gas. We face grid constraints and a political debate about restarting nuclear power, where Germany could take off leaf from Japan's book. There's also the innovation gap. While the US and China are pushing frontier large language models, think on how quickly players like DeepSeek emerged. Germany and Japan are mostly adopters, not creators. If AI isn't deeply embedded into manufacturing, core competitiveness could slowly erode. Megatrend number three: aging societies and the rise of the silver economy. Demographics are a relentless force. While global population growth is slowing, Germany and Japan are already deep into a demographic decline. This puts pressure on growth, public finances, and innovation. Pension and healthcare costs are rising, squeezing budgets that are also needed for defense, green infrastructure, and innovation. Fewer workers means less potential growth, and aging societies can become more risk-averse. That's not ideal for innovation. But here again, there is a flip side. Recent data shows something remarkable. People are staying healthier and mentally sharper for longer. 70 is the new 50. And it's no longer just a slogan. By better integrating older workers and extending effective working lives, both countries can soften their democratic blow. And the silver economy itself is a growth engine. From medical technology and care robotics, where Japan is already a global leader, to tourism and high-quality services. So, what does it mean for today? We need to balance. We need to balance a tight budget against the necessity of self-defense. We balance the drive for competition against the resilience of our supply chain. And finally, we must balance the demand for high yield against our growing need for sustainability. Germany and Japan are willing to tackle the challenge head-on. We are upgrading technology, reforming institutions, and attracting talent and diversifying risks. In other words, we are not trying to restore the old version of globalization. Together, we are building on a framework of economic security that prioritizes resilience, stability, over headline GDP growth. Success should not only be measured by speed alone, but also by endurance. This is very much in line with Japanese thinking, which emphasizes lifelong learning, continuous improvement, kaizen and shukunin, the professional pride, dedication, and relentless pursuit of excellence. Thank you.
Thank you, Oliver. I think one thing that's very clear in listening to both NAKASO-san and Mr. Behrens is that there is definite alignment in terms of how they view the challenges in 2025, but also the opportunities for 2026. So Oliver, if I could turn it back to you. We've discussed these challenges, we've discussed the cracks. Now let's talk about what you think the reforms need to be. So we've identified the issues, perhaps we talk a little bit about what the solutions could be.
Thank you again, Tracey, putting me on the spot again. Regarding to the mega trend, geoeconomic fragmentation and protectionism, for both Germany and Japan, the first priority is de-risking, not cutting ties, but avoiding overdependence on a single supplier, especially for critical raw materials and key technologies. The strategy is often called friendshoring, moving parts of supply chains to trusted partners. Beyond friendshoring is friend financing. We must ensure that knowledge, capital, and technology transfers remain in friendly hands. Germany, for example, launched a raw material fund in 2024, supporting projects that extract, process, and recycle critical minerals. The idea is simple: secure long-term inputs for digital industries and defense, rather than being exposed to sudden geopolitical shocks and overnight extreme price hikes. Security, however, is not only about supply chains. It is also about hard power. Germany and Japan are both increasing defense capabilities, but in different ways. Germany has committed in meeting the NATO 2% target. After Russia's invasion of Ukraine, it created a €100 billion special defense fund and even carved defense spending out of its constitutional debt break, something that would have been unthinkable a few years ago. Japan, meanwhile, is broadening its security partnerships beyond the US, reshaping its post-war security posture. Despite all diversification efforts, Germany is still deeply dependent on China for green tech inputs like lithium batteries And as an export-heavy economy, German industry continues to feel the pain of global trade fragmentation. Fewer open markets, higher costs, and more uncertainty. Regarding to the megatrend AI-driven productivity and the age of electricity, AI is not only about innovation, but even more about application. Germany and Japan don't need to become the next Silicon Valley. What they need is to move from being AI users to AI integrators. We must invest in digital infrastructure, gigabit networks, data centers, and cloud capacity to revive productivity growth. In addition, the age of electricity, driven by EVs, heat pumps, and AI data centers, requires a massive upgrade in power grids and storage systems. As Microsoft CEO Satya Nadella said at this year's Davos Forum, energy cost and infrastructure availability are now key determinants of which countries will lead in the AI race. Germany has started to move faster. In 2024, the construction of the new extra high voltage lines, roughly 1,700 kilometers, increased fivefold to 2021. But still, electricity prices remain structurally higher than in the US or China. For energy-intensive sectors, this is like trying to win a marathon while carrying a heavier backpack. Regarding the megatrend, the silver economy and demographics, demographics is a slow-moving trend, but also the most decisive. Like long winters in the north, you don't fight them, you prepare for them. Our both countries need to mobilize labor more effectively. That means higher participation of women and older workers and narrowing the gap between the official retirement age when people actually stop working. Germany has taken some steps into this direction. Under recent tax reform, people who continue working beyond the statutory retirement age can earn up to 2,000 euros per month tax-free. At the same time, skilled immigration is no longer optional. Germany's recent reforms, including the Opportunity Card, lowered entry barriers for qualified foreign workers and led to an 11% increase in visa applications. Japan is moving into the same direction, especially in healthcare, engineering, and technology. The goal is not to burden younger generation, but to rebalance the system in a fair and sustainable way. This is less about radical cuts and more about smart incentives, encouraging longer participation, healthier aging, and flexible life course models. Sorry for my long response. Thank you.
That was excellent. Thank you so much for that, Oliver. I'm now going to turn to you, NAKASO-san, to hear your thoughts about how we move from these challenges, opportunities, how we actually create solutions.
Okay, thank you very much. I will focus on basically on the financial area, and there are 3 points I want to make in this regard. First, enhancement of the Japanese yen as one of the key currencies. Now, according to the BIS statistics, Japanese banks have been the largest provider of cross-border credit since after the global financial crisis. But the yen portion of the cross-border loans thus far has been rather modest. And I think this can be expanded. And that will pave the way for a wider role of the yen to be, the wider role to be performed by the yen in the global financial markets and the capital markets. In the same vein, the government's policy plan for promoting Japan as a leading asset management center must be steadily promoted. The plan, originally launched by Prime Minister Kishida, remains high on the policy agenda set forth by Prime Minister Takaichi, and now with a broader objective of supporting Japan's economic growth. And inward investment into Japan by global investors will, I think, result in a wider, higher portion of money allocated to yen-denominated assets, which I think would in turn enhance the role of the yen as the international currency. That's the first point. Second point, I think we need to upgrade the functioning of Japan's financial center. Our financial center should so function as to serve not only the domestic clients, but also those firms operating in the Asia-Pacific economies that constitute important supply chains for Japan. I think this effort must be pursued with a view to supporting sustained growth of our partner economies, as well as addressing the common challenges, most typically climate change. And in this regard, I think developing an efficient transition finance market in Japan would provide firms and banks in the region with better access to issuing yen transition bonds or to trading carbon credits. And thirdly, most fundamentally, confidence in the yen must be maintained. Now, the value of the yen measured in terms of, for example, a real exchange rate has been in a secular decline since the bubble burst in the early 90s. But more recently, the yen's exchange rate has declined against major currencies recently. I think to a substantial degree, I think this is caused by, for example, the expected further deterioration in Japan's fiscal position as the Takaichi administration promotes the so-called responsible expansionary fiscal policy. This results in higher bond yields and weaker currency. I think the weak yen also has to do, the current weak yen, I think also has to do with the monetary policy. Japan's CPI inflation rates have been overshooting the price stability target of 2% for now 45 months in a row. They're concerned in the market that the BOJ might fall behind the curve against persistent inflation pressure. This is also driving, in my view, yen weaker and long rates higher than otherwise. I think this argues in favor of fiscal policy measures that aim at restoring a sustainable fiscal structure with a view to ensuring credibility in the fiscal management is so important. For monetary policy, I think the BOJ should proceed with rate normalization without delay, in line with the macroeconomic and inflation trajectory. And in the meantime, growth strategy remains a key policy agenda as improvement in macroeconomic fundamentals will underpin the value of the yen. So by addressing these three challenges, Japan should be able to perform a better role in the shifting global economic and financial landscape, filling the gap, if you like, created by US receding from international arena and America first proposition. I think Japan should collaborate with other providers of reserve currencies, including the euro, sterling, Swiss franc, Canadian dollar, as well as financial centers like Frankfurt that share common goals. We will be able to contribute to the international community in a more efficient, effective way if we endeavor collectively. And lastly, just a point reacting to Oliver's point on the labor shortage. This is absolutely a big issue for us. You mentioned the labor participation rate, but we have done so much in this area. For example, our labor participation rate for the young female has now reached 80%. That's higher than the US, UK, and the elder generation works longer than any peers in the advanced economy. So I think this leads us to the conclusion that how we should deal with the immigration policy going forward, meaning importing labor force from abroad. And this, incidentally, is one of the big topic in the current election campaign.
Thank you so much for that, Naka-san. You mentioned some very interesting areas, quite a breadth of discussion about both fiscal and monetary policy, and perhaps the next time that I'm in front of Deputy Governor Himino-san, I might mention that to him. Okay, so let's move to our final question that I think is incredibly relevant for this panel, which is the collaboration point. Looking ahead, I'd like to ask both of you what you see as some of the most promising areas of future collaboration between Tokyo and Frankfurt as financial centers. I'm going to start with you, NAKASO-san. Yes.
Thank you. I think the phrase that best describes the long-standing relationship between Germany and Japan is ferne Gefährten, which means distant companions. This is because we have many things in common, although our countries are distant geographically. The diligence of our population has overcome limitation of natural resources, transforming our economies into economic powers, if not superpowers. Today, the labels made in Japan or made in Germany are a guarantee of quality and excellence. And both economies rely on the industry base that comprises layers of Mittelstand companies. We have same issues, constraints like labor force, like you mentioned. We also have challenges in common that argue in favor of collaboration between financial centers of Tokyo and Frankfurt. I want to mention three areas for possible collaboration that I can think of. First, since both economies are bank-centric, we need to develop an alternative investment chain that channels growth capital to potentially promising industries and firms. That can be done by leveraging the capabilities of asset managers, but banks can do more. Banks in particular, those banks in the region possess rich information on local, small, and medium-sized companies or even startups, and some of which, of course, may one day become a unicorn in the future. However, banks can only extend loans, and are constrained in providing equity capital. And meanwhile, a financial center is best positioned to collect information on investment demand of both domestic and global investors, willing to provide promising local firms with equity capital. So financial centers can therefore perform, I think, as an intermediary connecting regional banks and global investors. And this is probably an area for future collaboration. Secondly, collaboration could be made in the climate to address the climate change, given the huge amount of capital needed to achieve net zero goals. Public funds cannot cover. So private capital must be mobilized in order to fill the gap. And in doing so, we have, at least in Japan, focused on so-called transition financing, which is to incentivize not just green projects, but amber projects that can enable companies to realistically achieve net zero goals. And third area is AI. We heard in the panel discussion yesterday that AI has a tremendous transformational impact on improving productivity and effectiveness of financial services industry. So maybe this is an area where Tokyo and Frankfurt could work together to stay ahead of the curve, to reap the harvest.
Thank you so much. Oliver, could you close us out in about a minute and a half?
I do my very best. So looking ahead, the most promising area of collaboration between Tokyo and Frankfurt, in my eyes, is a platform type of partnership, aligning energy transition, trusted technology, especially AI and RegTech, and long-term asset management, areas where financial centers can actively shape outcomes and not just observe markets. I can cut it here to give you a minute back if you want to.
Thank you, Oliver. Let me just wrap up the panel right now by saying thank you to both panelists. I think this was an incredibly interesting, reflective conversation talking about some difficult issues, but that is the reality that we're in, and I think it bodes very well for both Frankfurt and Tokyo to become critical international financial centers in 2026 and beyond. Thank you. Thank you so much.
ありがとうございました。モデレーター
Thank you very much. Thank you to the moderator and the speakers. Once again, let us express our gratitude with a round of applause. Please leave the stage.